The SEC recently adopted amendments to Regulation Crowdfunding and the definition of emerging growth company to implement inflation adjustments mandated by the Jobs Act. Here are the highlights of what's changed, why it's important, and the new thresholds. If you're considering raising capital using Regulation Crowdfunding, the investment limits and the thresholds for the different financial statement requirements have changed. First, there are limits on the amount that non-accredited investors may invest in crowdfunding offerings in a 12-month period. Those limits depend on that investor's annual income and net worth. Under the new adjustments, the annual income or net worth threshold to determine how much an investor can invest increased to $124,000. If the investor's income or net worth is less than $124,000, they will be able to invest up to at least $2,500 or 5% of the investor's income or net worth if that amount is greater. Investors with annual income and net worth of $124,000 or more can invest up to 10% of the greater of their income or net worth, not to exceed the new threshold of $124,000. Next, turning to the financial statement requirements. Companies conducting a crowdfunding offering must file with the SEC an offering statement with financial statements. The financial statement requirements are based on the amount of crowdfunding securities that the company is offering. Under the new adjustments, companies offering up to $124,000 of securities under Regulation Crowdfunding are generally required to provide financial statements that are certified by the principal executive officer. Companies offering more than $124,000 and up to $618,000, or companies conducting their first crowdfunding offering of up to $1.235 million, are generally required to provide financial statements that are reviewed by an independent public accountant. All other crowdfunding offerings up to the maximum aggregate amount of $5 million require financial statements that are audited by an independent public accountant. The rules also changed for emerging growth companies, or as some call them, EGCs. Companies that qualify as EGCs may choose to follow scaled disclosure requirements. Under the new adjustment, to qualify as an EGC, among other things, a company must have annual gross revenue of less than $1.235 billion. You can find the new thresholds by clicking on the infographic linked below.